Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. I hope all of you are doing well. We're very excited because we've been getting quite a bit of feedback on some of these podcasts that we're doing on a weekly basis. And primarily, our goal is to provide education because at the end of the day, there's a tremendous amount of information out in the marketplace. But information without education always leads to failure. Now, over the last 3 weeks, we've been talking quite a bit about the fact that it's very critical for all of us and for most Americans to try to get to a 0% tax liability in retirement. And we do a webinar on a weekly basis, which is called How to Divorce the IRS in Retirement and How to Do So Legally. So 3 weeks ago, we did a podcast on qualified plans. And those are your traditional 401ks and IRAs and some of the other qualified plans that are available in the marketplace. And the fact that although they may be a good accumulating vehicle, especially when you're putting money away on a pre-tax basis in order to accumulate assets at retirement, they are a horrible retirement distribution vehicle. And there are many reasons that we talked about at that point in time. Not only are those assets taxable at some point in time in the future, and that's a big difference between either taxing the seeds or taxing the harvest. But most important is the fact that unless you do proper economic model and economic planning, there's a very high probability that the distribution from those qualified plans, those 401ks and IRAs, not only is it going to create a tax liability out of those plans at a point in time where you want to pay the least amount of taxes, but moreover, it can create tax liability in other areas of your life like capital gains distributions, Social Security benefits, and so forth. Then we had a podcast on retirement distribution issues and concerns. And what were some of those issues that the vast majority of Americans, as they approach retirement, they don't have enough knowledge or know-how about economics, and it creates a tremendous problem for them because they're not able to dig deep into all the issues and concerns that can have a dramatic effect on retirement distribution planning and on a successful retirement. Those are, for instance, measuring and adjusting and fixing some of the major issues and risks that Americans have to deal with in retirement. The risk of dying too soon, the risk of living too long, the risk of living with a disability, the risks of living with eroding factors like inflation and taxation. And as we mentioned in many of these podcasts, inflation is not tax deductible. So if inflation rate is at 3% in the United States, you may have to earn, depending on your tax bracket, anywhere between 4 and 4.5%, sometimes even 5% in order to be able to meet that 3% and stay with inflation, with the hopes of always making certain that your assets are staying ahead of inflation. So we did talk about that. We also discussed the issue with climbing a mountain, and as you're going up the mountain, those are the accumulation years of your life. And then when you get to the top of the mountain, that would be the summit. That would be the time that you're about to go into your retirement life. And then as you start to come down the mountain, there are many booby traps and issues and holes and slides that you have to deal with, and things that you have not even planned for. And we talked a little bit about that. If getting old is bad, getting old and having no money at all is even worse. And for many Americans, it's sad to say this, but many of them are going to run out of money before they run out of life. And we used some of those examples along those lines. Today I want to do a fairly short webinar. We're going to continue on the trip to creating a tax-free retirement life. The last podcast that we did last week was one on what I consider to be by far the best preferred retirement distribution plan, which is a 7702 plan, which uses a life insurance shell in order for Americans to be able to put away a lot of money on a tax-preferred basis without allowing the IRS to have any control over those assets in retirement. As a matter of fact, according to the statistics, over 75% of the U.S. Congress is contributing heavily to these 7702 plans. And there's a reason why. They make the laws so they understand the features and benefits and the tax benefits, and they also understand where taxes are going to be in the future. Today I want to continue along that path, and I want to share with you another vehicle. And as I've said before, there are only 3 vehicles that are totally exempt from any taxation under the IRS code once you have paid the tax on the contribution. And those are the Roth IRAs, and the Roth 401ks, and the 7702 plans. Today I'm going to spend a little bit of time on Roth IRAs, which is a Roth individual retirement account. And as we all know, when you put money into a Roth IRA, you have already paid taxes on that money. So you're actually paying taxes on the seeds, and you're never going to have to pay taxes on the harvest. So one of the analogies that I often use is the one of, if you happen to own a wheat farm, would you rather pay taxes on a few bushels of seeds in the spring, or do you want to pay taxes on truckloads of wheat in the fall? Obviously, for most of us, I would rather pay taxes on the seeds than having to pay taxes on the harvest at some point in time in the future, especially when we all know where taxes are going to have to be in order to mitigate all of the liabilities, the funded and the unfunded liabilities, and the debt that we have in this country, and how that debt is continuing to increase on a pretty much on a daily basis. So once you put money into a Roth IRA, the money is going to grow on a tax-free basis. The distribution is also going to be on a tax-free basis as long as you have had that Roth IRA in place for at least 5 years. Now, you can open multiple IRAs. The IRS thinks of it as all being one, so that 5-year rule will only apply to that first Roth IRA that you open, and then all of the others will qualify automatically. Now, as every government plan, these Roth IRAs have limited contribution amounts. And for 2018, if you want to make a contribution to a Roth IRA, the maximum amount that you can put into that IRA in 2018 is $5,500, $5,500. But if you happen to be age 50 or older, the IRS allows you to have what they call a catch-up contribution. So you're eligible to contribute an additional $1,000 to your Roth IRA for a total of $6,500. Now, Roth IRAs, at least on the contribution side, they do come with income thresholds that you must meet. And in 2018, if you're single, and you make less than $118,000 a year, then you have the ability to max fund your Roth IRA without any issues and concerns. Once your income starts to go north of $118,000, you're going to have certain handcuffs to the point that you may not be able to contribute to a Roth IRA at all. Now, if you happen to be married, filing jointly, and you wish to continue to a Roth IRA, then obviously you have a little bit more liberty on your side, because the IRS will basically say that as long as you and your spouse do not earn in excess of $186,000 for 2018, you will be able to make full contributions. Both you and your spouse will be able to make full contributions of $5,500 or $6,500 if either one of you or both of you happen to be age 50 or older. Now, one of the challenges with Roth IRAs is you have no access to accumulated funds or to the accumulation in that Roth IRA prior to the age of 59 and a half. Now, there's a caveat that I'm going to talk about especially on that line item in the next few minutes that I think will give most of you that are making contributions to Roth IRAs a little bit of freedom along those lines, but not everything is free from that perspective. So whenever you are putting money into a Roth IRA, the goal is to make certain that you don't touch that money until at least the age of 59 and a half. Now, one of the beauties of Roth IRAs as compared to traditional IRAs or to traditional 401ks, as we have talked in the previous podcasts, is that there is no required minimum distribution at the age of 70 and a half. Remember, in traditional IRAs and qualified plans, if you don't take money out of your qualified plan at the age of 70 and a half, not only are you going to have to pay taxes on that distribution that you failed to take, but the IRS is going to assess what they call an excise tax or a penalty, which is equal to 50% liability on top of the taxes that you would have paid. So if you were supposed to take $5,000 out of your IRA or 401k and you failed to do so at the age of 70 and a half, or if you delayed it until April 1st of the following year after the year that you turned 70 and a half, then you're going to have to pay taxes on that $5,000 depending on whatever your tax bracket may be at that time. But also you're going to have to pay a $2,500 penalty, which is equal to 50% of that $5,000 that you should have taken, but you didn't at that point in time. So those of you that have traditional IRAs and traditional 401ks have to be very, very careful as you start to approach the age of 70 and a half. With a Roth IRA, you don't have to worry about that. You actually can allow that Roth IRA to continue to grow for as long as you want that money to grow. As a matter of fact, there is no obligation on your part, according to the IRS, to ever withdraw that money from your Roth IRA. And upon your passing, then that Roth IRA will then go to your beneficiaries on a tax-free basis as well. So those are critical aspects of Roth IRAs, and that is why I recommend that to my clients quite a bit as we prepare and engage our clients in creating a customized retirement blueprint, which we do for our clients on a regular basis. Now, another beauty of a Roth IRA is that there are no Social Security tax triggers. Remember, any distribution from a qualified plan, whether it's an IRA, 401k, a SEP, a 403b, gets added on as ordinary income when you're doing provisional income calculations, and those distributions could have a negative impact on the taxation of your Social Security benefits. Your Social Security benefits could be taxed either at 0%, 50%, or 85%. Well, it doesn't matter how much money you distribute out of a Roth IRA. It is not taken into consideration to figure out the calculations for provisional income, and it will not have a negative impact on your Social Security distribution benefits. Next week, we'll do a podcast on Roth 401ks, which also enjoy some of the same features, but you must be careful in how do you execute that as well. Obviously, Roth IRAs are credit protected, so it doesn't matter how much money you have in a Roth IRA. If you get sued by any reason, and obviously in the United States we live in a litigious society, then it's not going to have any negative impact on you or your family from that perspective. So those are a lot of the features and benefits that all of us have the ability to enjoy by making contributions to a Roth IRA. Another beautiful thing, and this is more on the tax aspect of a Roth IRA, is the fact that, whenever you put money into a traditional IRA or 401k, not only are you deferring the taxes, but you're also deferring the tax liability. And remember, the IRS and the U.S. government controls that liability. So in reality, I don't care how much money you have in a 401k or an IRA. In traditional 401ks or IRAs, you never know how much of that money actually belongs to you until you start to take the distribution, because at that point in time, the IRS will determine what percentage of that money that you think is yours actually belongs to the IRS. With Roth contributions, you know exactly how much belongs to you. The account value belongs to you, and the IRS does not control the timing and or taxation of those vehicles once you meet the guidelines. Now, one of the line items that I shared with you a little while ago was that there was no access to the accumulated funds prior to the age of 59 and a half. And there are a couple of things there that are actually pretty helpful from a business perspective, at least for many of my clients. One of the benefits of a Roth IRA is that, as I've stated, that contributions can always be distributed out of the Roth IRA with no tax. And no early distribution penalty as well, even if you happen to be age 59 and a half. So let me give you an example. Let's say that you put $5,000 away into your Roth IRA and you put that money in for 5 years. Then obviously you have made contributions of $25,000. Perhaps that Roth IRA has grown to a higher level, and I'll give you an example in a few minutes. But at least that $25,000 that you're taking, that you put in as your contribution, you do have the ability to take it out if you wish. Now, under the distribution ordering rules, all Roth IRAs are treated as one Roth account, as I said earlier. Now, contributions are deemed to be the first amount distributed. Then you can distribute conversions, which is traditional for accounting purposes, is what they call FIFO, first in and first out. And lastly, the earnings are distributed. So let's go through a simple example that I think will bring about the point that I just tried to make a couple of minutes ago. Let's take a look at a gentleman by the name of John. He's age 45. He has made Roth contributions totaling $30,000. He has actually done 3 Roth conversions of $10,000 each and has total earnings of $20,000 in his Roth IRA account. He wants to take a distribution of $25,000 from one of his Roth IRA accounts, and the first $25,000 will come, or these $25,000 will come from his total contributions of $30,000. It would be tax-free and penalty-free distribution, because at the end of the day, that is his money for this exercise. Now, the Roth, and this is where it gets a little tricky, the Roth IRA custodian will issue John a 1099-R for the $25,000 distribution. and will actually mark the box for taxable amount, and they will mark that box unknown. I've come across this several times because we at Cambridge also do tax planning, and they're going to code the distribution as an early distribution if you did that distribution prior to age 59 and a half. So obviously those are things that the 1099-R will show. Now John is going to have to file Form 8606, which is a form that is used fairly often with his tax return to basically tell the IRS that his distribution is not taxable. Now, since this is John's first Roth distribution, he will need to know the total amount of his contributions. Now, where is John going to be able to get this information? Well, obviously, traditional tax software will generally be able to track Roth contributions, even though that they do not show up on the tax return. Now, the IRA custodian issues what is known as a Form 5498 every year, and that will show the amount of contributions made for the year. Now, Roth IRA statements will show contributions received for that year. Now, John could have kept copies or his own list of contributions he made for each year, and that would be a very good thing to do, because I'll share with you the reason why. But at the end of the day, it's a lot of paperwork for John to track. But it is John's responsibility to do this type of tracking. It is not up to the Roth IRA custodian to do so. As a matter of fact, John could have more than one account, and he could have moved his accounts from one custodian to another. So it makes it virtually impossible for his Roth IRA custodian to keep track of all his contributions. By the way, it is not up to the IRS to track John's contributions, although in theory they could, since they get copies of the Form 5498 showing what contributions John has made for each and every year that he made contributions to the IRA, to the Roth IRA. So at the end of the day, it is John's responsibility to track his contributions. And if the IRS were to audit John or question him, he needs to be able to prove the amount that he claims as a distribution, which was part of his contribution, and therefore not taxable again. If he cannot prove the amount of contributions, he could very well owe income tax and also a 10% early distribution penalty on part of that distribution if any of that distribution is deemed by the IRS to be from his earnings in the Roth. So basically, you can pull your contributions prior to age 59 and a half without having to pay taxes or penalties, but you have to make certain that you keep track of all your contributions so that you can prove to the IRS that they're not taxable. The growth of the IRA, you will not be able to pull without having to pay taxes or penalty until you reach the age of 59 and a half. So again, I thought that would be a good topic to cover today, because it is critically important that as you prepare to engage and embark on a tax-free retirement life, that you understand the rules of engagement. And we here at Cambridge do this every day, so we have a very clear understanding in how to customize our retirement planning for our clients, and most important, how to customize a distribution effect so we can take advantage of the standard deductions and the credits and the exemptions that our clients are going to be receiving in the future under the IRS code, in order to be able to max out their distributions, be able to increase and maintain their standard of living without having to mitigate and pay any additional taxes or pay any type of taxes to the IRS in retirement. As always, our job here at Cambridge, and my number one job, is to help you and everyone on this call to change the way that you see things. Because when you do change the way that you see things, the things that you see change. So again, have a wonderful day, and we'll talk again next week.